So if you just stop for a second and think about the sheer scale of global trade, I mean, the billions of tons of goods moving across oceans and borders every single day, you'd probably assume the system running it all is, this super efficient high-tech machine. It's not. The infrastructure that governs this whole complex dance is, and this is shocking, it's often based on really outdated and fragile technology.
It's a huge systemic vulnerability. I mean, the entire process is just burdened by manual work, mountains of paper, and data standards that don't talk to each other.
So when there's a problem, like a shipping crisis or a big surge in demand,
Exactly. The organizations, they often just kind of throw people at the problem to manually sort through all the documents.
and even when they try to modernize, the problem is just so deep-seated. We've seen sources detailing how major global banks are spending, fortunes upgrading these internal legacy systems.
But they're not touching the core problem.
No, which is how they interact with everyone else. We found this just truly absurd anecdote about a major European bank. They're relying on a system where the chief architect retired 30 years ago.
Well, I've heard this one.
They still have to call him out of retirement just to fix major bugs. I mean, that's the very definition of a fragile and inflexible system.
And that fragility is exactly why we're seeing this geopolitical scramble right now. This isn't just about getting a slightly newer version of Excel. This is a battle for what people are calling digital sovereignty. The shift to distributed ledger technology, to blockchain, it's central for countries who are trying to reduce their reliance on Western financial systems.
Like Swift.
Exactly, like SWIFT, which has been criticized, for its opacity and its perceived political vulnerability.
And the inefficiency on a human level is just glaring. Even with all this bank digitization, that global trade finance gap we always talk about, it hasn't been solved.
Not at all.
You see these super digitized banks still rejecting loan applications from small and medium-sized businesses, SMEs, at basically the same rate.
All right, the digitalization, it reduces costs for the bank, but those savings are not translating into the financial inclusion that was the whole point in the first place.
Why is that?
It's just a simple cost-benefit analysis. A bank doing due diligence on, say, a $100,000 SME loan often spends more on verification and paperwork than the profit they'd make. The current system just bakes in that inefficiency.
Okay, so the old system is broken, it's expensive, and it's exclusionary. Our mission today is to deep dive into this global race to replace that whole mess and really to seize control of the next generation of a global trade infrastructure using blockchain. We've got sources detailing major sovereign strategies from trade finance to these geopolitical alliances that could really define global commerce by 2030.
So to really understand that race, we should probably start with the technology itself. When we say blockchain, what we're really talking about is distributed ledger technology, or DLT. It's a technology that stores data permanently across a whole network of computers secured by hash algorithms and consensus mechanisms.
Which makes it basically tamper-proof.
Essentially, yes. And we are way beyond just cryptocurrency applications now. We're in what some experts are calling blockchain 4.0.
Blockchain 4.0.
Yeah, it's all about industrial demands, high efficiency, and network scalability, specifically for things like logistics and supply chain management.
But I have to ask the critical question, why DLT? If the problem is these digital islands, all these siloed databases, why couldn't we just create one massive centralized database, run by the WTO or a big shipping consortium or something? What does the distributed part actually add that justifies this huge pivot?
That's a great question. The distributed nature adds two things that are just non-negotiable in this space: trust and immutability between competitors. If you have one central database, everyone has to trust the central authority running it.
And in global trade, the stakeholders are ports, customs, carriers, banks. They're all rivals.
Exactly. They operate under different sovereign controls. DLT lets them share operational data in real time, knowing that the rivals can't tamper with the record and without having to rely on a single third party.
That makes perfect sense. So it's a trustless system built for entities that don't necessarily trust each other but need to cooperate. So how does this actually translate into what people are calling the smart port revolution?
Well, the application is very practical, and the benefits are immediate. DLT is being applied directly to port management. It enables real-time sharing and recording of port equipment usage. So the movement of cranes, the allocation of trucks, warehouse inventory, all of it is logged on that shared ledger.
So everyone's seeing the same data at the same time. Which has to mean much faster operations and less friction, right?
Precisely. It radically optimizes how resources are allocated. It cuts down equipment idle time, reduces port congestion. When every single party, the vessel operator, the port authority, the customs agent, has immediate verified access to the same single source of truth, vessel turnaround times improve dramatically.
And our sources pointed out this incredible side benefit that really aligns with global sustainability goals. They call it the green bonus.
Yes.
The example was Costco shipping high eco. They're using blockchain for carbon reduction traceability and certification. And since the shipping industry is responsible for, about 3% of global greenhouse gas emissions, verifiable on-chain proof of being green is a huge application.
It's more than just PR. It's auditable data tied to the ledger. That verifiable audit trail is the key. It moves environmental claims from the marketing department into the realm of hard data.
Okay, so let's peel back the next layer here. Managing the physical movement of goods and port equipment, that's one thing. But the real prize, it seems, is digitizing the ownership and financing of the cargo itself.
Yes.
And this leads us straight into this enormous economic opportunity in tokenization.
Tokenization is the critical financial pivot in all of this. It means taking electronic bills of lading EBLs.
Which are the legal titles to a shipment.
Right. And you convert those title rights into secure, tradable digital assets or tokens. This transforms what was a static digital document into a dynamic liquid financial instrument that you can trade and finance, instantly.
So you're literally creating an entirely new securitized asset class based on real-world goods moving across the ocean. That fundamentally changes the whole economic landscape.
It changes everything. This new tradable asset class can directly help bridge the world's estimated, $2.5 trillion trade finance gap.
A $2.5 trillion gap.
Yeah, and remember how banks avoided those small SME loans because the due diligence cost was too high?
Right.
Tokenization standardizes the underlying asset. It removes that friction. So banks can create these risk-weighted pools of tokenized EBLs. They can move away from direct, complex lending and more toward their expertise in securitization.
That is a profound shift in risk management. So traditional banks suddenly go from being lenders to becoming, risk pool managers, packaging these EBLs for institutional investors.
Exactly. And that allows them to improve their return on equity without necessarily having to increase their capital requirements.
And the big institutions are already reacting to this.
They are. The Federal Reserve Bank of New York's Innovation Center has already completed proof-of-concept work for settling these securitized trade flows. So this is moving out of the lab and onto the roadmap of major financial regulators.
It feels like a generational leap.
It is. It's comparable to how China basically bypassed credit cards and jumped straight to QR code payments. They created a whole new ecosystem almost overnight. Tokenization could let global trade finance make that same kind of jump.
Okay. And here's where it gets really interesting. This whole race is clearly not just about supply chain efficiency or, bridging a finance gap. This is about shifting global economic power. Defining these new digital rails is a direct challenge to the existing Western-dominated dollar system.
We are absolutely witnessing the geopolitical lines being drawn. The clearest challenge is coming from emerging economies focused on de-dollarization and these new digital alliances. In 2024, the BRICS plus nations, Brazil, Russia, India, China, South Africa, and now with new players like Saudi Arabia and the UAE, they unveiled what some analysts are calling a monetary nuke.
A monetary nuke. That is strong language. How does this platform actually bypass the dollar system?
Well, it operates through a few highly connected components. First, it heavily uses national digital currencies, mainly the ECNY and the digital ruble, as its transaction rails. Second, it uses smart contract-based commodity swaps, which lets member nations trade in their local currencies, all backed by these transparent on-chain contracts. And third, it's exploring using tokenized gold reserves as a kind of mutual reserve currency.
And all of this is done outside of traditional system.
All of it. It's facilitated through decentralized clearinghouses designed specifically to avoid the choke points of systems like SWIFT.
And the real-world impact is already happening.
It is, absolutely. Our sources indicate that in early 2025, Saudi Arabia executed $4 billion in oil contracts using the yuan.
$4 billion?
And the UAE launched a dirham yuan ruble basket for trade settlement. So this isn't just theoretical. It signals a very concrete digital-first shift in geopolitical alliances.
And at the same time, China is aggressively building out its physical logistics rails to match these financial goals.
Correct. China is pushing policy to enforce full digital integration. A perfect example is the Yantian port. In April 2025, they launched Shenzhen's first blockchain-enabled rail sea service. It connects directly to the national digital platform, ensuring this real-time, immutable sync of all operational datagate movements, vessel loading, customs updates,
Creating a totally interconnected ecosystem.
an ecosystem that maximizes control and minimizes friction for their trade partners.
So let's shift focus. The UAE and the Gulf Cooperation Council, they seem to be prioritizing speed and regulatory flexibility. What's their play here?
The UAE is making crypto a central pillar of its entire economic diversification strategy. They are explicitly aiming to be a global tech hub and reduce their oil dependence. Dubai's Virtual Assets Regulatory Authority, VARA, has issued some of the world's most comprehensive and, frankly, business-friendly regulations.
And they're also moving on central bank digital currencies, or CBDCs.
Very much so. The UAE Central Bank has unveiled detailed plans for both domestic and cross-border use, and they're actively participating in the BIS-led Enbridge project to test how sovereign digital currencies can interoperate.
Okay, so let's contrast that agility with the traditional economic powerhouses, the US and the EU.
Yeah.
Our sources suggest a much more fragmented and, well, cautious approach.
That's putting it mildly. The U.S. position is often summarized with the critique that the U.S. invented blockchain only to ban it,
Right.
that it's lost momentum due to regulatory arrogance and just internal fighting. You have these ongoing turf wars between the SEC and the CFTC.
The Securities and Exchange Commission and the Commodity Futures Trading Commission.
Yes, and this fragmentation just creates immense uncertainty for anyone trying to innovate in the space. So while the U.S. Fed says it's open to considering a digital dollar, they're moving at a glacial pace compared to the BRICS and GCC nations.
So the U.S. is kind of paralyzed by this regulatory infighting. Meanwhile, the EU is defining its future through really robust regulation, focusing heavily on this idea of digital sovereignty.
That's the key difference. The EU is defining its digital space through proactive legislation, not reactive lawsuits. The Cyber Resilience Act, the CRA, is a fascinating example. It forces companies and consumers to be really intentional about the security of the open source components they use in their digital infrastructure.
That sounds incredibly complex for a logistics company that might rely on thousands of open source packages. What does that liability shift actually mean for someone running a smart port system?
It introduces a dramatic new liability framework. So imagine you're a major shipping firm. You use a specialized open source platform for your logistics. If the entity that provides paid support for that open source component has any kind of monetization model.
Like a support contract.
Exactly. They can now be deemed a manufacturer under the CRA.
Yeah.
This creates what's being called a manufacturer gray area for liability. It means if a security flaw in that open source code leads to a system failure or a breach at the port, European regulation can hold the support provider responsible.
Wow. Even though they didn't write the original code, that is a profound commitment to digital sovereignty. You're securing the entire software supply chain by demanding accountability.
It directly addresses the security of all the dependencies in the system, which is crucial when your digital trade infrastructure is your new national infrastructure.
So, what does this all mean then? It seems like the race for control of global trade by 2030 is less about who has the best code and much more about who gets to write the rule book for that code.
That is the synthesis. By 2030, global trade is not going to run on a single universal system. Instead, it'll likely operate across several highly regulated, sovereign-controlled blockchain networks. You'll have the BRICS Plus platform, the EU digital spaces defined by MiCA and the CRA, and the agile GCC rails defined by Vera. The fragmentation of these regulatory standards is shaping the world map of trade far more powerfully than the technology itself.
So the final takeaway for you, the learner, is this. Tokenization is fundamentally transforming the financial instruments tied to global trade. It's providing a genuine, scalable answer to those legacy system failures and, crucially, that massive SME finance gap. This is a quiet but profound war being fought over supply chain ledgers. And the battle lines are drawn between countries focused on interoperability and alliances, like the BRICS and GCC pilots, versus those who are prioritizing strict regulatory control and digital sovereignty, like the EU and the fragmented US.
And this leads us to a really crucial, provocative thought for you to consider. While the technology, blockchain, it solves the problem of those non-interoperable digital islands in trade, The rise of all these competing sovereign regulations risks replacing those old islands of technology with new and potentially much larger islands of jurisdiction.
That's a powerful idea.
So how will truly seamless global trade function if the new digital infrastructure is designed not just for efficiency, but to reinforce national control? You can see the WTO struggling right now to adapt existing trade law, like GATT and GATS, to cross-border data flows. It just perfectly illustrates this tension between digital liberalization and sovereign regulatory interests. And that battle between efficiency and control is what will ultimately define the next decade of global commerce.